Today's RBA meeting minutes have indicated that another interest rate cut is in fact possible. On the phone with me now to talk through what this could all mean for the Aussie dollar is Kara Ordway of City Index. Kara, today's signal from the RBA is the third month in a row that the central bank has given observers information not available in its original announcement. Given the Aussie dollar rally seen off the back of what had been considered as vanishing bias following the initial meeting, is it fair to say that the RBA perhaps should consider a smoother way to communicate their messages?
Well, certainly we did see a rally this afternoon after those minutes were released, but really I think that was more a willingness of a market to buy into the Australian dollar and buy into those high-yielding currencies this afternoon off some risk appetite following through from the US overnight. And certainly there has been considerable interest over the trading day in those high-yielding currency pairs, as I said. In terms of the minutes that were released, really there wasn't that much surprise in terms of what the RBA was saying. There was some indication that they felt the stimulus was now in place. And I really think now that it's given the market some indication and put on a conclusion that really now that we won't see a rate cut until 2014. In terms of their communication, there's some expectation that we'll hear further hawkish views from Glenn Stevens from the RBA later on this week. But really at the moment, I think they are playing it fairly safe, and I think it's fairly safe to say that they will continue to do so until we hear any further news both out of the US and domestically.
The central bank has been pretty steadfast in its view that the Aussie dollar is overvalued and that it would like to see the currency fall further to help Australian industry. Nonetheless, most forecasters are now saying that a rate cut is not likely to happen until early 2014. What is City Index pricing in?
Certainly, I think that's correct. Now, I think we'll be looking to around February 2014 at least before we see another rate cut. As I said previously, really they'll be looking at domestic data and domestic data coming out of the US to make that decision. But at the moment, they're really focusing on the good news that's come out of the economy. We've had better consumer and business sentiment out recently after the elections in the Australian economy, higher house prices. Really, though, the focus may move towards that unemployment figure that is set to rise to around 6% later on in 2014. And really those growth projections that have been out from the IMF that have been slashed globally, but including the Australian economy. So certainly, as I said, it won't be until early 2014. Really, their focus, once again, as you said, was on that currency being too high. However, they have made the point that it is still at least 10% lower than those highs that we saw trading in April. So there is still some room to move for the RBA in terms of keeping those rates on hold for some time to come.
The Aussie dollar has been the tricky performer of 2013, labelled the worst performing currency in the opening months of the year. Is this performance likely to continue into Q4, do you think?
I think this is entirely dependent on what we see in the US. The story of the year has very much been the tapering, the expectation of when this tapering will occur. The focus was on the September month Fed meeting. That didn't happen, and now what we're seeing in terms of the US shutdown means that data out of the US is going to be delayed. So really now traders are talking about this tapering not occurring until next year, 2014. So I think their performance in terms of Q4 will largely depend on this US dollar performance. And if we don't see any tapering until 2014, the potential for the Australian dollar to move higher is certainly there. In terms of the shorter term, really we'd be looking at that 95 level as the very well advertised barrier that we broke through in last night's session. And above that, really the 95.50s. But between the 95.50s and 97s, there's not considerable orders in the market at the moment, and that is really our next target in terms of the Australian dollar moving forward, that 97 level. So if we do continue as we have been, if we do get a resolution in the US, which is very much widely expected by the market, and that's why we have seen some good risk sentiment flowing through into FX markets, and then we don't see any tapering until 2014, certainly this trade can continue up into those levels.
And lastly, Andrew Salter of ANZ has commented that exporters can expect the Aussie dollar to ease by mid-2014. Is this an estimate that you would agree with? And similarly, what fundamentals do we need to see from the Australian economy to support that?
I certainly think, as I said, going into 2014, it will be tapering that's back on the table. And with that back in play, it will be certainly a US dollar long that traders are focused on. And for that reason, we will see probably some pullback in those risk currencies, those high-yielding currencies like the Australian dollar, like the Kiwi dollar. And really there'll be more of a focus, as I said, on the unemployment levels and what the RBA want to do with that in terms of growth prospects throughout 2014. So really looking for a higher level towards the end of the year up to the 97s, 98s max. Certainly I wouldn't be talking about a parity level, as I know some traders are, but really those type of levels for the end of the year, and really then a pullback into 2014 back down to the 91s, 92s as things settle down in the economy and maybe traders start to talk about interest rates once again.
Thanks, Cara. That's all we've got time for right now, but I'll be back shortly with a look at the Israeli shekel. Goodbye for now.